I'll give a quick intro. Hey guys, we are here with JJ from Outlier Ventures, and he'll be giving a talk on tackling liquidity challenges in India. Can you guys confirm that you can hear him once he starts talking?
Hey there.
You can give a quick intro on yourself and just continue talking, and they'll let you know if they can't hear you.
Sure. So hi guys, my name is Joelle. I work as a research analyst with Outlier Ventures. Just to give you context on what I'll be presenting on, I'm looking at how synthetic digital currencies could likely solve the liquidity issues that come in emerging economies, specifically with India in the backdrop. So the reason why I'm looking at this is because remittance and financial inclusion is one of those things people in the Bitcoin space have been looking at since 2012. Things have changed a fair bit since then, both in terms of scale and stability of currency. So what I was trying to do was to see if it is possible to use some of the tools in DeFi today to try and tackle user experience problems. The reason why I've taken India specifically is going to be evident quite soon when I show you the figures around internet penetration in India and the size of the actual market itself. So now that you've confirmed you can hear me, we can get right into this. So just for a sense of scale, India has about over a billion people using telephones of some kind. We have roughly 500 million people using the internet, of which around 200 million use the internet on a daily basis, at least for an hour. Actually, the chart here is not officially updated yet. The real number should be around 600 million in this chart right now. And in terms of pace of internet penetration and growth of users, India is actually one of the fastest. And this also has direct implications in terms of how we look at financial instruments. And the biggest application of the financialization of India is actually within remittance. So India is one of the countries that receives the most in remittance. So it's roughly about $80 billion. Not a huge figure when you consider that Tether's market cap itself is roughly in the $6-7 billion figure right now. I think India has been going through this transformative phase over the last decade, partly because we had this temporary shock in 2016 when our currency system itself was banned, in the sense that we had no fiat notes that were accessible for a whole 2 months. So what happened during that phase was people rampantly started using digital currency. And if you really notice the Bitcoin price chart itself, they actually started having an uptick somewhere around November 2016 when this incident itself happened. So on one side, you have a very young India that's coming online. You have an India that's also paying online constantly. And you also have this country that should ideally be perfectly positioned for DeFi and everything it offers, because we don't just look at financial instruments to speculate or trade with. We also consume a lot of digital goods, both in the sense of things like Netflix, Spotify, games. It's across the spectrum. In fact, India also has one of the lowest costs per GB that you might pay almost anywhere in the world. But when you look at specifically at the blockchain ecosystem in India, it's actually been lagging considerably behind. So I have two of the best exchanges in India here in these charts. That's CoinDCX and WazirX. CoinDCX was backed by Bain Capital. WazirX was actually recently acquired by Binance. So it's one of the success stories in India. But when you look at them in terms of volume and traffic, they're actually considerably behind any of their peers. Now, of course, you can say that something like FTX has derivatives and its volume would very likely be in multiples of what WazirX or CoinDCX has. But even when you account for the amount of Indians that are online, we lag considerably behind. So I was actually curious about whether I can point out to one definitive fact that proves that India is really, really behind in terms of where we should be with blockchain adoption. And the best figure I could actually find was how much we've actually funded Indian companies. So last year, I happened to do some research work, and I found that blockchain firms across the world since 2011 have raised roughly about $30 billion. 28 was the accurate figure, and India has raised only about 30 million of the total, which I found to be not so perfect considering the size of the market and the number of people here. So the reason why I'm giving all this context is because at the crux of all of this is the fact that India is not in the ideal spot, both in terms of UX and in terms of the on ramps. And there is a last problem that is there, and this explains why there is such a high premium. That is, the regulatory environment is really confusing. So while putting this together, I was actually looking at headlines over the last 6 years. Some of these have been traumatic. We've had founders put to jail because they were experimenting with Bitcoin ATMs. We had a proposition that people could be put in jail for custody of digital assets at one point. Luckily, that wasn't passed as law. We've had the cops involved with Ponzi schemes. We've had Ponzi schemes that would blow your mind in terms of size. So, on one side, you have people that are actually interested in investing in these tools, and on the other side, you have a market that's fundamentally broken. And you combine those things, and you have a market where Tether is almost always trading at a premium, and you don't have a fair market price for Bitcoin in the regional currency. So if someone asks me what's the price for Bitcoin, actually about a year or two back when Tether was taking off, you would have almost always found a premium or a discount of about 5 to 10%. And that's the premium that people are willing to pay for quote unquote capital flight or just having sovereignty over the digital assets. What's happened since then is Tether has come to market and people have actually started acquiring Tether at a premium. So during the incident in March 12th, Tether was trading almost at a premium of 20%. And so you combine these factors and you have a highly volatile environment where it's not easy for you to on-ramp people. So with all of this in context, I was actually thinking about the role DeFi has played in India so far, and what does all of this mean specifically in the context of India and other emerging economies. So we have three startups that have actually taken off in the last 2 years or so. That's Delta Exchange, Nuo, and Instadap. And I specifically mentioned these because they are what I would call DeFi natives in some sense. Delta Exchange is a derivatives centralized trading platform, but it settles in USDC, so it's got that working out for it. Nuo and Instadap are DeFi primitives. One of them offers lending, and the other is a UX interface. The reason why these firms could actually build on DeFi and scale globally in comparison to their regional peers was because there was literally permissionless innovation, right? Like if in the traditional regime, you basically wait for licenses, you wait for having access to a global market. Something that's built on DeFi can go global on day one. And that actually opens opportunity for a very huge market in India to be building for the global market. The other is in terms of dollars, both their custody, receiving, and sending. The experience on USDC is considerably better than what you could have on something like a bank transfer. So, for context, the first time I received my income from Outlier Ventures, which is a UK-based entity, I actually had to go to the bank and verify that I am Joelle John, and I'm receiving this payment because I work with them. So that kind of, I won't call it harassment, but that kind of frictions do exist in terms of receiving payments. So the way I see it is things like USDC, DAI, maybe even USDT is enabling a new generation of founders to be building for a global market while being based out of India. But the problem is you take any of these emerging economies, almost all of them have a premium against the dollar, which may not necessarily be a healthy indicator. So if you just take the stablecoin market today in Tether, you will notice that at least about 80 to 85% of the volume and market cap is concentrated around Tether. Now that's natural power law, but for a healthy ecosystem, you also need decentralization of currency types that are available so that you can offer better user experiences. So, so this was the broad scenario that I was dealing with when I was looking at this problem in particular. And there were basically two key solutions that I came up with, and three others that I found quite interesting. So we'll go into them right now. So the the simplest solution really.
I don't know what you mean by, hey Siri.
Okay, sorry, I had my phone go off. So the simplest solution you really have is have something similar to the DAI issuance, but instead of having ETH locked up in it, you go ahead with something like a USDC or even the DAI itself. So what you're really doing here is you're moving the currency risk from a volatile digital asset to a stable currency, and then you're basically creating regional stable coins on top of it. Now, what happens when you supply these regional tokens is they would always likely trade at a premium even in the regional markets. But in terms of pricing and in terms of having people offload the cognitive effort of calculating how much is tether in my regional currency or how much am I actually paying for this digital commodity, you're basically making it far more easier for them. Now, there are risks with this, and the fundamental risk here really is the fact that if your exchanges don't integrate this, you really have no go-to-market, and you really need a wide network of exchanges adopting it. And that's been the actual case even with something like USDC or even USDT, right? Like you need the exchanges coming on board and using it. But the upside is, if you notice, you have this user here that can actually be paying for their regional needs. They can be paying for games. They can be also investing in things like Aave Finance or Pool Together with their regional currency. And if you have a complex enough mix of regional currencies, like let's say the INR, AED, CNY, you would eventually have a synthetics forex market. The problem is, again, unless this sees substantial value, both substantial value and volume, this may actually struggle to really take off the foot because what we've seen with multiple regional currencies like the CNY and JPY and even the euro is that unless there is actual adoption by dApps or by exchanges, these projects would very likely struggle to go beyond $10 million in volume. So that's when I was thinking about what's the alternative. And what I eventually concluded with was that, hey, you got exchanges that are offering lending and borrowing against margin trades. They also offer staking services. So why isn't it possible that we have an alternative with their idle assets? So just as a friendly reminder, if you have questions, do drop it in, or you can just add it to the side of the chat. So back to this. So what I was thinking was, if you have USDT, and the largest risk with USDT today is the lack of verifying the assets that actually back it. But in comparison, you can realistically pull up data on how much Bitcoin Binance has, Huobi has, and Coinbase has using something like Token Analyst, and you can keep an eye on it in real time. The data relays for these are also available in an API form, provided you can get an oracle that works with it. You could realistically make a decentralized enough solution. Now, one of the things that actually happened while I was working on the slide is the WBTC model was integrated with MakerDAO. So if exchanges want to go to that length, they could even have wrap Bitcoin and create regional synthetic currencies so long as MakerDAO is on board with it. The problem really here is, how do you determine the collateral ratio, right? So even if it is at 2x the float amount of the regional currency that you issue, when something like what happened in March 12th happened, when price went right from 9,000 to 3,500, it's very likely that the exchange could lose whatever it has issued in terms of the regional synthetic currency. And that is a risk that exchanges may likely not take on board. So how do you incentivize it? The solution that I was coming up with was, maybe there is a new model that may work, and that is, how about we make it such that there are fees that's added for each transaction, and there is also a fee for holding these currencies. Now, I get it. It sounds a little crazy when you compare with existing DeFi stablecoin solutions. The reason why I mention this is because when you issue currencies in an emerging market like India, you don't want the synthetic INR to be competing with your state issued currency. So All you want it to be doing is serve its function in a smart contract or be used in a transaction. And as long as that is done, there should not be a fee. But if it is being used for, let's say, quote unquote, hodling, maybe you should integrate a fee so that you disincentivize people to be engaging in behaviors that basically remove liquidity from the market. So what this would do is, if you have a large enough market and if you have a large enough token velocity, that is, people are constantly transacting between themselves or engaging with smart contracts, it could prove to be more profitable than what exchanges currently earn through some of the other sources that they have. It may take a while, but I believe that something like Binance is very likely in a good enough position to be pulling it off, and I'll explain why in the next slide. So we'll start with point 3 on this slide. So if you're trying to create a truly global remittance network, the first thing you need is a truly global network of bank accounts that can receive money and send money on the other side, right? So when you look at Binance's acquisition of WazirX and some of the other plays that they have in terms of regional currencies, it kind of becomes obvious that they're making it as easy as possible for me to be sending INR to someone in India and have it settled in dollars to someone in New York. And what would eventually or very likely happen in the next 5 years is that you have a global network of P2P exchanges that make it possible for you to send money to anyone in the world. There are some other models that are coming, and one of the particularly interesting one is, I believe, transfer routing across multiple exchanges. So what that means is, if it's quite common in centralized exchanges, but it's becoming more common in P2P exchanges like Ramp and Transact, which are new players in the industry today. What they do is, if you have a $10,000 order, they basically break it across multiple exchanges and give you real-time liquidity for that, which also could likely be a solution for the premiums that we see in emerging markets. But assuming in the next 3 or 4 years, the regulatory environment around stablecoins change, there's also very likelihood that we'll see 2 more things coming up. One of them is something similar to what SET protocol does, but except instead of having it on your ledger, you could very likely have it on banking APIs with a centralized pooled fiat account. And what that would do is give large liquidity pools for people that are looking to go into fiat or come onto crypto. So the model that could very likely work there is you have a percentage of the transaction itself going to the people providing this liquidity as a fee. Now you may wonder why does all of this matter, right? Like why would you really care about DeFi and stablecoins, especially in emerging economies where there's no volume? So my philosophy, or the way I approach this, is that we're not really just creating digital assets that can be speculated on. These projects actually serve very necessary functions in the economies that they could be eventually adopted in. So if I take something like Unlock Protocol, who I would personally be a user of very soon, they actually make it easy for me to accept payments in credit card and have it settled in DAI in a fraction of the time that it would take me to have an account in Stripe in the US, or something similar to like Open Law, but realistically have an improvement on the legal experiences that I have with the environment in India that is far better and faster in real time. So one way to think about DeFi is that you're not just creating on-ramps towards your speculatory instruments or your stores of value. You're also allowing people to build entirely new business models. And in a COVID-like environment like now, where people are increasingly working from home and they're looking for new financial tools to both collect payments or distribute payments, and environments where the existing financial infrastructure is really lagging behind, this is a stack that is actually allowing people to catch up in leaps. So that's the philosophy at play here. And I think some of the startups that are doing really cool things is Groundhog, which is actually a subscription payments business, or something like Gilded, which allows you to run something similar to FreshBooks, but in a DeFi stack. So I believe stable coins being used for trading is just the hook, but it won't be long before people realize that this is a way to really be completely off the traditional banking ecosystem altogether. So yeah, that's the entirety of my presentation. I'm open to questions. If you have any, alternatively, you can just reach out to me in my email or Telegram. Okay, there are a few questions that's coming in. Yeah, I could give some context, right? So, why has there been such little investment in Indian blockchain companies? So, I've been in the space since 2014. The biggest challenge really is the lack of clarity from the regulators that are there. Um, the, the so the first legal statement from the Reserve Bank of India came in 2014, and the second actually came around 2018 April. So it takes a long time for the government to be really clear on what they intend to do, and even now they've not actually completely signed off on the token ecosystem. They've only said it's not banned. So for any investor that's looking to come in, there is that risk that, hey, what if the government decides that tomorrow we are going to issue our own CBDC, and everything that we can't completely control is not good for us. What the government is really missing there is that things like stable coins are way more trackable than the traditional financial ecosystem, and something like a USDC can have faster financial analysis than anything that the banks in India can provide today. So it's also a matter of the regulators catching up. Uh, in regards to comments or suggestions about DeFi, uh, quite frankly, I've not seen anything. But what we've had is there is this think tank named Niti Aayog. They had issued a paper suggesting that blockchains, not public blockchains in particular, but blockchains can be used for some of these financial instruments like likely tokenizing startup equity in the future. But there has been no formal statement, and that is a huge part of why India is lagging so much in terms of both adoption and investment. Do I feel DeFi is safe enough to be off the traditional system? Actually, no. I would say we have a long way before anything can really take scale within DeFi today. So if you really notice teams that hit scale, things like Compound, Maker, uh, either they switch to a foundation or they switch to a non-DeFi model altogether. And that is fine because it's what everyone sees about blockchains, right? It's like the late 90s. We've still not figured things out. But what we've also heard from regulators, including ones at the IMF, is that digitization of financial infrastructure is very much a priority, and DeFi has a role to play in it. So it will likely take one time because people still need to figure out things like how do you maintain a peg, how do you maintain the economics around the ecosystem, but you also need user education. You also need the regulatory environment becoming clear around it. And that is when you have something that's really ready for scale. And that's why you're seeing CeFi, DeFi hybrids like Crypto.com or some of the Binance offerings seeing scale today because they're bringing that much needed quote unquote safety and security to, to to the space right now, right? Like you can trust Binance or something like a Nexo, but you may not want to blindly trust a smart contract if you don't know how to read code. Uh, Truth be told, there aren't many blockchain slash DeFi groups in India. One of them is India Bits. It's one of the few. I'll just add it to the chat actually for you. Uh, It's one of the oldest Indian crypto communities. We discuss DeFi there occasionally, but there is some work that is being done in regards to curating information around the DeFi ecosystem. So I'll send it across your way once it's done. Any other questions?
All right, guys. So if we are done with questions, what we're going to do is take, let's see. Actually, let me double check and see if the other speaker is available right now.
All right. Yeah, if there's anything else in particular I could answer around the Indian ecosystem, just drop in your questions. You can also follow the blog because I occasionally write about the DeFi space in the context of emerging economies there too.
All right, guys. The other speaker is ready. We are going to port you guys over. Thanks so much for the really informative talk. It was great.
All right. Take care. Bye.